Hello and welcome. You're watching live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. According to the latest World Economic Outlook report by IMF, about a third of the world economy faces two consecutive quarters of negative growth. Global inflation is forecast to rise to 8.8% in 2022. Upside inflation surprises have been worst widespreading among advanced economies, and the risk to the outlook remains unusually large and to the downside, says the IMF report. What's the kind of impact that countries like India could witness if things go from bad to worse? To talk on this and more, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Welcome, Mr. Basu.
Thank you, Geetu. Good evening.
Very good evening, sir. Starting from the report that IMF has generated on the World Economic Outlook, it says that currency depreciation risk intensifies food energy crisis in developing economies. How isolated is India, sir? Is the scenario that we are seeing in India quite different from what IMF is really looking at emerging markets? We have been doing really very well as far as the emerging markets are concerned. What is your take on this?
Well, India is doing relatively well in this global downturn and this episode of global inflation. But of course, India cannot be immune. It has a lot of strengths. One very important strength is that the Indian economy has been deleveraging over the last 8 years. Credit growth has been very modest until the last 3 or 4 months. Credit growth over the last 8 years averaged just about 9% a year, which is really very modest, not even growing as fast as nominal GDP over that period. So that is internal deleveraging. Externally, India's external debt increased by only about 36% over the last 8 years. That compares to a 296% increase between 2004 and 2014. So again, there's been very modest increase in external debt. India's nominal GDP has grown much faster than external debt. And so the external debt to GDP ratio, which was 24% in 2014, is now just 19.2%. So India has deleveraged externally, it has deleveraged internally, and so is in much better shape in dealing with this global downturn and this inflationary episode than most other economies are. There are a few economies in Asia that are actually doing just as well as India. I'd point to Indonesia in particular, which is a commodity exporter. It exports, it's a net exporter of oil and gas. It's an exporter of palm oil, rubber, tin, coal. So most of its export prices are going up. And so Indonesia is looking quite good. So Indonesia has twin surpluses as a result. That's a rarity for the first time in maybe 25, 30 years. So Indonesia is doing okay. Vietnam is doing fine. But with those three exceptions, India, Indonesia, Vietnam, most of Asia is actually suffering. Most of the world is suffering. But I would also point out that emerging economies are doing a lot better than developed economies. There are problems, not so much in the emerging economies as in what would be called frontier economies. So if you think about the emerging economies, there is one problem country in the emerging world, and that is China. China has a property crisis. It has an industrial overcapacity crisis, and it's got an economic slowdown that has been exacerbated by its very strict COVID lockdowns. Plus now it's got a new Politburo standing committee that came in. None of the 7 members of the Politburo Standing Committee have any experience running the economy, apart from Xi Jinping, who doesn't really have hands-on experience of managing the economy either. So there is a worry that China is going off the rails, and that is a concern. But with that exception, if you look across most of Southeast Asia, economies are in reasonably good shape. Other emerging economies, Brazil Of course, Brazil is having a presidential runoff today, but actually it's tomorrow, I think, 28th of October. But Brazil's economy is in pretty good shape as well, because Brazil, like Indonesia, is an exporter of commodities, and so is benefiting from high commodity prices at the moment. So Brazil is in fine shape. Most of the emerging market universe is actually in pretty good shape. The problem areas are what are called frontier markets that are outside the emerging economy, emerging market universe, where there is actually an additional vulnerability. So Sri Lanka is among those frontier markets. Pakistan is somewhere between a frontier and an emerging market. I'd say really more of a frontier market. Those are problem countries. Much of Africa, Zambia, for instance, has defaulted like Sri Lanka on its external debt. There have been problems with external debt in a number of sub-Saharan African economies, which are extremely indebted to China. So there are these problem areas. Now, with regard to inflation, I don't want to downplay the inflation problem, because we are facing it too. I mean, India is not immune to the inflation problem. And India is facing an inflation problem, despite the fact, as I've been emphasizing for several months, India's broad money growth was actually very modest. India's broad money grew slower. Average growth of 11% over the COVID period was slower than the 15.4% average growth in the previous 30 years. So India was actually containing its monetary growth. It should have seen some benefit on the inflation front, but unfortunately, global supply issues caused inflation to pick up. And of course, the most important problem for India was extremely high crude oil prices, and of course, other commodity prices as well. So India, being a trade-oriented economy now, cannot be immune to global market forces. And so India has suffered from the inflation problem. But again, suffered a lot less than the developed world. I think it's worth emphasizing that the real problem countries in this cycle are not the emerging economies, but the developed economies. That is where the recession is going to be really bad. I'd say that Europe is already in stagflation, and that includes the United Kingdom. The United Kingdom has been through a terrible episode in markets over the last month or so. It was the irony of ironies that a brown man's burden. Rudyard Kipling, a century and 20 years ago, 120 years ago, was talking about white man's burden, and now the United Kingdom turned to a brown man to rescue it from an economic and financial disaster. Yes. Anyway, I think Rishi Sunak has made a good beginning, but it's only been 2 days since he took over as Prime Minister of the UK. But over that month, the UK has been through an absolute roller coaster ride. And part of the problem is that the UK has a very large current account deficit. I think it's often forgotten that if you are the world's reserve currency economy, like the United States is, you can afford to run current account deficits and the world will finance it, because the world is forced to have your currency. But if you are from a relatively small currency economy, Britain was, the pound, or what was called sterling, was the world's reserve currency until about 1925-26. A century ago, it was the world's reserve currency. Today, pound is the GBP or the sterling is now a minor currency. It is still a minor reserve currency. Many central banks still hold it as a reserve currency, but less than 3% of most foreign currency reserves are held in pounds. And so it doesn't have the extravagant privilege that the United States has. And so the UK, the previous Prime Minister, Liz Truss, came in with a promise to cut taxes. And she did so at a time when the economy was already suffering from nearly 10% inflation. And at a time of 10% inflation, if you cut taxes drastically and try to provide a fiscal stimulus, the markets, of course, will react very badly, because that's going to exacerbate the inflation problem,
Right.
and make it very difficult for the country to finance its external debts. And of course, will cause the current account deficit to widen even further. From 7% of GDP in the last quarter, it'll probably widen substantially further. And the world will not be willing to finance that widening deficit. And so the consequence was an absolutely rapid sell-off in the sterling, as well as in gilts. Historically, for historic reasons, British bonds are called gilts. They used to be the most valuable type of bonds in the world. But that's distant history now. And if you have unsustainable economic policies, then you'll be punished. And Britain was punished severely, so severely that within a week of the so-called mini budget being introduced by Kwasi Kwarteng on the 23rd of September, just after our last monthly call, there was an absolutely rapid sell-off in both sterling and gilts, and Kwasi Kwarteng was sacked within a week. He was replaced by Jeremy Hunt, who had supported Rishi Sunak during the Conservative Party leadership race of the summer. And then when the Home Secretary was sacked by Liz Truss, she was replaced by another Rishi Sunak supporter. Those were the first Rishi Sunak supporters in the government. But that was more or less a sign of things to come, because when Liz Truss became Prime Minister, she appointed a cabinet of pure loyalists, almost like Xi Jinping. She appointed a cabinet of people who supported her. So it was a very narrow cabinet. And if you have a very narrow cabinet like that isn't a broad tent of even within your own party, then if you're going to have bad policies being introduced, there's no support. And so the whole thing collapsed very, very rapidly. And she turned out to be the shortest serving prime minister in the UK's history. She served less than 50 days and was replaced very, very quickly by Rishi Sunak, who comes in as somebody who is expected to stabilize markets. And his sober initial speeches have already calmed the markets. The sterling is now back where it was before 23rd September. Gilts have more or less, made up all the ground. They made up all the ground the day after he took office. They've sold off a little bit after the budget for 31st October was postponed to 17th November. But effectively, all of the bad news of the Liz Truss period is seemingly forgiven by markets. But of course, Sunak and Hunt will need to deliver. So, but I think that was illustrative of the problems of developed markets. This is a developed market crisis. This is not an emerging market crisis. This has now become a developed market crisis. And Britain has been at the vortex for a month, but most likely Germany is already in recession. And Germany is actually not just in recession, but in stagflation, because Germany generally is a very low inflation economy. Now it is suffering from a very sharp slowdown in the economy, and also from much higher inflation than it's been used to. And across Europe, in fact, you now have stagflation. With the United States, this week we'll probably get a better number for US GDP growth in the third quarter. We'll probably see a bit of a rebound in third quarter GDP. But nonetheless, the US appears headed towards a recession by the third quarter of next year. So second half of next year will be a period of contraction for the US. And that is going to be a consequence of the extremely rapid move up in policy interest rates in the US. That has had to occur, that will continue to occur between now and March next year. So I'm looking at the Fed fund rate getting up to 5% by March. In fact, markets are beginning to catch up with my forecast. I mean, markets are also now beginning to look at 5% as a very likely outcome for the Fed funds rate. But probably a little bit later, maybe April, May. But the point is that 5% is a dramatic shift from where the actual interest rate was until the March FOMC meeting this year, near zero, 0 to 0.25%. That seems a distant memory now. But with that very rapid tightening of monetary policy in the US, we are likely to see a developed market recession that will make things quite difficult. And of course, we are also waiting. I think that the period of dollar weakness, the period of dollar strength that we've seen, probably has another month or so to run.
Okay.
Because once markets begin to focus much more on the possibility of a recession in the US, then I think the dollar's rapid move up will end, and that I think will be a big relief. Of course, that will be a big relief to emerging markets. We have seen very volatile currencies. All emerging market currencies have actually sold off. The rupee a lot less than many others, including the Chinese renminbi. But the likes of the Japanese yen, the Korean won, you'll notice it is more the developed economic currencies that are selling off far more than the emerging market ones. So the Japanese yen is the biggest sell-off. The Korean won, in sympathy with the yen because it's a big competitor currency, and we've seen a number of other currencies across Asia depreciate rapidly. And that, of course, is a typical consequence of periods of US dollar strength, especially during times when US interest rates are rising rapidly.
If we talk about recession, that you just explained that the US might be heading towards recession. If that is the case, then we'll expect the crude oil prices to fall, dollar to weaken. So how good will that be for the Indian economy?
Well, once the dollar begins to weaken, then I think all emerging markets benefit, and India, of course, benefits too. The other key is for crude oil prices to come up. Now, with crude oil, it's been a bumpy couple of months because crude oil was beginning to focus on the likelihood of developed market recession and the slump in Chinese demand. Now, there really has been a very sharp slump in Chinese demand for oil, and those two factors were causing Brent crude to moderate sharply. Then, of course, you had the OPEC Plus production cut announcement, 2 million barrels per day production cut. It's very difficult for OPEC Plus to enforce this, but that helped to at least put a floor under the Brent crude price. And it has settled around $90 a barrel, a little above $90 a barrel. It had fallen quite a bit further. But my point about Brent crude is that if you look at the period from October 2021, that is a year ago, to March 2022, that 6-month period, Brent crude price averaged $90 a barrel over that 6-month period. So it is very unlikely that this year we'll get, over the period from October 2022 to March 2023, it's very unlikely that Brent crude prices will be much above $90 a barrel average over that period.
Okay.
So in effect, there'll be almost no increase in Brent crude prices year on year over the 6-month period, which basically means that the base effect will be very helpful for oil-related inflation. And I think that automatically inflation will start easing off. And it'll ease off for India quite significantly. I expect that the CPI inflation rate will be close to 6% in November. It will be below 6% by December. And once it goes below 6%, then there is no further need for the RBI to keep raising rates. I do expect there'll be another rate hike of 35 basis points in December. But I think beyond that, the MPC can pause. Now, with regard to the US, I think we'll begin to see better numbers from October as well. Inflation will be helped by high base effects. Headline inflation in the US and core inflation were above 4% from October last year. So once we get to October and November, the base effects will help. And the base effects will include the oil base effect too. So headline and core CPI inflation in the US and PCE inflation will begin to come off a little bit. And I think markets will respond better towards the end of November. And that's why I expect that we have just about a month more of dollar strength to come. And thereafter, the dollar should come off. And and then that'll be a huge relief for emerging markets. And within that, India is especially well positioned because increasingly the world is beginning to look at the need for a China plus one manufacturing strategy. Mm-hmm. And as manufacturers begin to look for alternatives to China, the first names that come to mind are India, Vietnam, and Indonesia. And those three countries are beginning to see the flows. We are clearly seeing a significant flow of new Apple product manufacturing occurring. So iPhones, the iPhone 14, iPhone 13. Increasing amounts being produced in India, parts being produced in India as well. We're beginning to see some semiconductor manufacturing move in. So that is already reflected in the fact that we have, the last month in September, India's exports of electronics were up 73% year on year. I mean, those are the sorts of numbers that I saw in East Asia through most of my career, but I haven't seen those sorts of numbers in India. I mean, it's nice to see that the electronics manufacturing revolution that came to East Asia maybe 20, 25 years ago is finally shifting into India. Now, electronics exports are just about 5.5% of India's manufactured exports at the moment, of total merchandise export, 5.5%. But just a year ago, they were 3.6%. So they're just picking up rapidly. You're beginning to see a significant ramp up in electronics manufacturing. Now, that cannot be the only basis for our manufacturing revolution. We need to see a much more broad-based revival in manufacturing. And I think, there's growing signs that Uttar Pradesh, for instance, a very, a state that has a huge surplus of labor. Uttar Pradesh is beginning to see labor-intensive manufacturing beginning to ramp up. Just yesterday, you saw that Walmart is planning to put another $2 billion of capital into Flipkart, which basically is a sign of attempting to boost not only its e-commerce platform, but really Walmart making a much bigger commitment to India as a destination from which it can source things like textiles, garments, shoes, toys, etc., which really is essential. I mean, we are still at a very early stage here, but if labor-intensive manufacturing, textiles, garments, shoes, toys, processed foods, etc., begin to to pick up significant momentum, then I think we're really off to the races, and we'll see the sort of industrial revolution that all industrializing economies witnessed in the early stages. Now, India has missed the boat. I'd say India has missed the boat almost every decade in the last 6 for labor-intensive manufacturing. But this time, I think many investors are beginning to understand that this is different. This time, India is really beginning to get its act together, and this manufacturing revolution is on the cusp of takeoff.
Mr. Basu, with inflation really not coming down, and with IMF targeting 8.8% for 2022, so what are the policy measures that the central bankers and the respective governments need to work on as far as the monetary and the fiscal front is concerned?
Well, 8.8 is the forecast for this year.
Yeah.
For next year, there will be a slight moderation. There is no question that with the aggressive tightening of monetary policy by the Fed in particular, and by other central banks, Bank of England, ECB, they're all tightening. And of course, the RBI is tightening. You've seen Bank Indonesia tighten. You've seen Bank Negara Malaysia tighten. You've seen, MAS in Singapore tighten. So across Asia, we're seeing a tightening of policy. We're seeing tightening in Latin America, in Europe. So, the exception, of course, is China. China is attempting to avoid tightening, which I think is a terrible mistake. But anyway, we'll come to China in a bit. The rest of the world is tightening, and as a consequence of the tightening across the rest of the world, we are beginning to see inflation moderating.
Okay.
And in India, of course, the last 2 or 3 months haven't been so good. There was a moderation in July, and then August, September, inflation picked up.
Yes.
I think October will see some improvement. I think October inflation in India should be just below 7%. And then in November, we'll get it much closer to 6% because the Kharif harvest will come in. And of course, we'll begin to see base effects helping as well. Plus, of course, oil and energy prices are coming off as well. So all of that contributes to slightly better inflation numbers going forward. I think we're likely to see better inflation numbers in the US as well to some degree. Now, unfortunately, Europe, because of its extremely self-defeating, aggressive stance towards imports of oil and gas from Russia, Europe is suffering far more. Europe is suffering higher inflation. And unlike the US, the US has seen record oil production this year. We're already beginning to see US oil production really start picking up. And unfortunately, in Europe, there is no such possibility. The UK has some oil, UK and Norway have oil, but not really enough. Norway doesn't have enough to supply to the rest of Europe. And of course, the rest of Europe has been dependent on Russian oil and gas. And so by taking this extremely aggressive stand towards banning imports of Russian oil, trying to diversify away from Russian oil and gas, Europe has shot itself in the foot and is suffering extremely negative consequences for growth and inflation at the moment. So, and unfortunately, I think the ECB, the European Central Bank, has been behind the curve, has been horribly behind the curve, to put it mildly. And they're having to play catch up, and they're doing it. They're trying to catch up rather quickly, and that is destabilizing European markets. So we've just recently had an election in Italy, a very important, the third largest economy in the European Union, and a country that has an extremely high public debt to GDP ratio, over 150%. So that is a country that has elected an extreme right-wing government. And there are two parties, the two minority parties within that coalition are very pro-Russia. Forza Italia, headed by Berlusconi, is pro-Russia. The League is, leans towards Russia as well. So I think it's kind of almost a backlash to the sort of policies being pursued in Europe, that now the third largest economy in Europe has elected a government that has significant pro-Russia elements. Now, the new prime minister, Giorgia Meloni, belongs to the most right-wing party of all, but she has gone along with NATO with regard to its Russia policy. And, so she's sounding a lot more so-called sensible. But the point is that Italy is a potential dissident in Europe at the moment. And there's incoherence across Europe because a lot of other countries, Hungary, Poland, are not in favor of these extreme sanctions because they know that they don't have alternatives to Russian supplies of oil and gas, and they can't afford the aggressive policies being pursued by Germany and others. And of course, we've even seen discord between France and Germany at the Macron-Scholz meeting over the last couple of days. So it's a difficult time, and if there can be a resolution of the geopolitical issue between Russia and Ukraine, that would definitely help the rest of the world as well. There were some indications of something moving on that front.
Yes.
But I think the Ukrainians will only come to the peace table if they are losing on the battlefield. And at the moment, the Ukrainians think that they are gaining ground. As long as that's the case, I think it's very difficult to see a peace initiative in the Russia-Ukraine war.
That was my next question, that is there a possibility of this war coming to an end, that you have answered. What is your expectation from the Fed this time, sir? Is it 50 bips or 75 bips yet again?
I think it'll have to be another 75 basis points. I think the next one will be 75 and the following one will be a bit smaller. 50 or a little bit more than 50.
And what about the RBI?
The RBI, I'm looking at a 35 basis point hike at its next meeting, which is in early December. Of course, the key for the RBI will be the next two inflation readings, which we'll have. We'll have one on the 12th of November for October. That will be certainly reported before the RBI, the next RBI meeting. The following one will not actually be reported before the RBI meeting. I think the RBI meeting is 7th to 9th of December. So there may be an indication of the likely inflation rate, but not an actual number. So I think 35 basis points. They'll do another hike of 35 basis points. And then once the November and December inflation numbers come out and they show a further moderation, then I think the rate hikes can be paused for India.
Please continue.
No. So I think So I'm looking at a pause, but not in the December. At the December meeting, there will be another 35 basis points.
It really so happens, sir, that your equity returns are negative, your bond returns are also negative. What is this, that is going to happen next now?
Well, equity returns are negative for the world. They're not so negative for India, of course. I mean, India has been a relative outlier. India's equities are probably up, I think, about 1% year to date, calendar year to date. So they're up a little bit. But the point is that if you add in dividends, there's a little bit of positive total return on Indian equities this year. Now, the point is that it's been a pretty bad year for markets. And you get a bad year in markets when you have a policy error being made by the major world central bank. And the Fed basically made a huge policy error. I've been talking about this since February, since we started these monthly meetings.
Right.
And the policy error was basically that the Fed grew its money supply, allowed money supply to grow at nearly twice the pace every month for 22 months. M2 was growing at nearly twice the record previous pace of any monthly M2 growth in the previous 100 years. So that extraordinary period of rapid monetary growth is now being unwound. Interestingly, it's being unwound, but not that aggressively. I mean, interest rates are going up, but if you look at M2 growth, after that 22-month period when it was consistent, even it averaged about nearly 19% year-on-year growth for 22 months. It is now still up about 4% year-on-year. So it's not gone to zero or negative. It's decelerated sharply over the last 7-8 months, but it's not yet turned. It's not contracting. Yes, they've taken the actions needed to rein things in, but the story's not over yet. So central banks are going to have to do a little bit more, and inflation that will slowly moderate as a consequence of that. So I think one of the points to note, for instance, is that the Case-Shiller index of housing prices in the US, the latest number was still up more than 15% year on year. But it is off its fastest pace. The fastest pace was in May at about 17.6%. So it's come down it's decelerated. And if you look at the month-on-month change, housing prices are actually coming off month-on-month. So they're still up a lot year on year, but month-on-month, they're beginning to come off. So, so you're seeing the impact of monetary tightness, and that is now evident. And I think we are past the worst period, particularly for US inflation. Unfortunately, Europe is still in a bad way. And the fact that the UK made these big policy errors over the past month has meant that there will be heightened focus on getting the house back in order in that important economy. So I think the UK is now the 6th largest economy in the world. So it's not irrelevant to the world, but it's of diminishing importance. And I think one of the factors that Rishi Sunak will be looking forward to early in his term is a free trade agreement with India. And it's something that he will effectively have inherited. He's kept the same trade secretary in place. Kemi Badenoch is considered one of the rising stars of the Conservative Party. She is in charge of international trade policy. And she has spoken of wanting to get a good deal done quickly with India, and this is almost central to what a post-Brexit Britain needs and wants to do. That is, build and deepen its economic ties to India, and then and use that to help build a stronger partnership with the Indo-Pacific Quad countries. So from a strategic standpoint, the Quad, Japan, India, Australia, and the United States, are going to become of central importance to the evolution of world politics over the next few years. And Britain, I think, will want to be a fifth member of Quad, or at least an associate member, as will South Korea. Now, South Korea is a little bit more ambivalent, but less ambivalent under the current president, because now this time the current president of South Korea is from the right. The previous one was from the left, and the previous president was more keen to keep some sort of equidistance between China and the US. But the current president is strongly committed to the US relationship. But of course, no South Korean president is particularly pro-Japan, which makes it a bit more complicated for South Korea in the Quad. But so there is a possibility of the Quad having at least two affiliates in Britain and South Korea.
Okay.
And I think that for India, over the medium term, building relationships with those five economies will really be the key to how quickly India can develop, because those five can be very strong partners for India and can provide a lot of potential capital flow to help India achieve its Make in India manufacturing ambitions, both in labor-intensive and electronics manufacturing. So I think that's one fact. Now, one other thing that I'd like to talk about is very relevant to the recent news cycle, and that is China. The Communist Party has just had its 20th National Congress, and the consequence of that Congress is really quite a dramatic change in the direction of Chinese policy on a variety of fronts. Because there was, of course, a dramatic episode on the penultimate day of the Congress when the previous leader of the party, Hu Jintao, was forced to leave. I mean, soon after reporters were allowed into the convention hall, some guards came in and actually rather unceremoniously removed Hu Jintao from his high seat. That was, there were attempts to play that down by various pro-China people afterwards. But the simple fact is that it was a ritual humiliation of the previous leader. The ritual humiliation was aimed at showing the Communist Party membership that Hu Jintao was no longer relevant. And the following day, we saw what happened. Li Keqiang, the premier, who has a PhD in economics and has been a hands-on economist and economic policymaker for the last 15 years at least, was removed not only from the Politburo, which has 25 members, and therefore they're removed from the Politburo Standing Committee, which has 7 members within that 25, but he was even dropped from the party's Central Committee, which has 205 members. So he's been utterly removed. He still remains the premier. He still is premier of China until March 2023. But like his mentor, Hu Jintao, he has been ritually humiliated. He's been removed from the Central Committee. Now, of the remaining members of the Politburo, the old Politburo had 25 members, of whom Li Keqiang was the most was most experienced in dealing with the economy. It was widely known that he was likely to be shunted aside. He's had 10 years, and it's time for him to be shunted aside. That's fine. But it was expected that he would at least stay in the Politburo, if not in the Standing Committee. Oh, at a minimum, stay in the Central Committee. But he's been gone from everything now. So that's one very symbolic step. Then, in addition, Hu Chun-hung was another vice premier, member of the Politburo, who had experience with economic policy. He was also an economist. And he's only 59 years old. He was not on the standing committee previously. He was a member of the 25-member Politburo, but he was a vice premier. Vice premier in charge of the economy, along with a 70-year-old vice premier in charge of the economy called Liu He. Now, Liu He is known to be very close to Xi Jinping. Liu He is 70 years old, so he's at the retirement age. So Liu He was removed from the Politburo and the Standing Committee. That was one surprise. But Hu Chun-hung, who is 59, should have been promoted from Politburo to the Standing Committee and made premier because he has economic experience. But he has been removed from the Politburo altogether. So there's virtually one. Then there's another one called Wang Yang. Wang Yang was former Guangdong Party Secretary, number 4 in the Politburo Standing Committee, the outgoing Politburo Standing Committee. Another person with solid economic experience. He was vice premier in charge of the economy for 5 years in the past. He has been removed from the Politburo altogether as well. So there is nobody. Now, the entire Politburo Standing Committee has no one with economic experience. From what we can tell, the entire 25-member Politburo has zero economic experience. And this has really spooked markets because it's a really astonishing thing for there to be nobody with any technocratic experience of running the economy in the entire Politburo. So the focus seems to be on strengthening the military and challenging the world, and also cracking down on the technology sector and the entrepreneurial sector. We've seen that crackdown since November 2020, when the listing of that company on NASDAQ was dramatically pulled at the last minute. Now, with that, we began to see a crackdown on the entire technology sector that hasn't eased off. I mean, the technology sector crackdown has persisted, and as a result, we've seen a widespread sell-off in China's technology stocks. So we now have a situation where the second largest economy in the world is, after March, going to be in the hands of most likely Li Qiang, Xi Jinping's protege, who was party secretary in Shanghai. Now, he was party secretary in Shanghai during the COVID lockdowns of earlier this year. And the COVID lockdowns earlier this year were widely criticized because they were very poorly handled. And most people thought that Li Qiang had ended his chances of being elevated to even the Politburo Standing Committee. But not only has he been elevated to the Politburo Standing Committee, he has been elevated in the second rank. So he is now in line to become the next premier of China. Markets are very nervous about him. He has no experience of nationwide economic policy. He does have a little bit of experience dealing with economic matters in Shanghai. There's no question. But to the extent that he has done that, he hasn't done it particularly well. And so it's very concerning to markets that we have this extremely important economy, the world's second largest one, facing a real estate crisis, a huge amount of overcapacity in both real estate and industrial capacity. And it really has nobody in charge. So it's worth noting that in the past 12 months, China has had a trade surplus of $907 billion. But its foreign reserves over that period are down by nearly $200 billion. So it's lost, it's got capital outflow, capital and services and income outflow amounting to about $1.1 trillion over the past year. These are quite mind-boggling numbers. They aren't yet crisis-worthy for China. They are not. They may be very large numbers, but they're not yet crisis-worthy for China. And I'd also point out that, the Japanese bubble, when it burst far more drastically than what we've seen in China so far. China's property prices are down only about 20% from peak to trough. They're not in Japan. They declined 86%. Commercial property prices declined about 86%. Real estate, residential prices in the 6 largest cities declined more than 50%. They declined nearly 60%. So we haven't seen that yet in China. But China is very likely in the early stages of a Japan-style economic, financial sector meltdown, and the consequences will not be good for the medium term. For India, though, I think it's an opportunity in some ways. There are of course dangers. The dangers are on our borders, because when a country is in trouble economically, one way to overcome its domestic troubles is by lashing out internationally.
Right.
And China can lash out at many countries. It can lash out at Taiwan. It wants to lash out at Taiwan, first of all. But if it lashes out at Taiwan, it'll probably see a naval response from the United States. The United States has indicated quite clearly that it'll respond with naval actions if China tries to invade Taiwan. It could take more action in the South China Sea, as it continues to do, despite having quite friendly people in power. In the Philippines, the current president, Bongbong Marcos, is quite friendly to China. In Malaysia, the ruling UMNO is relatively friendly to China. So South China Sea, is another potential area where China is going to continue to make trouble for its neighbors. And then the Himalayas in Tibet. So we need to continue to stay vigilant, because that is a concern. But as China takes these sorts of actions, the reality is that in the medium term, it's going to keep losing some of its manufacturing. Supply chains that used to be completely centered in China are becoming more diffuse. They're moving out of China. And India and Vietnam are the current major beneficiaries of that. And we'll continue to see more of that over the medium term. So that's very good news for India, frankly, over the next 2 or 3 years.
One last question, Mr. Basu. IMF has stressed upon fast-tracking the green energy transition. We have been talking about this for quite some time now, but countries have really failed on this front. Your view?
Yes, I think the Egypt meeting of COP27 will be very important. And the IMF is beginning to focus on this. But the IMF has actually praised India as being one of the pioneers that is making a lot of progress on the green transition and the move to hydrogen and other sources of green energy. But I think it is important to understand that in this area, as in many others, with regard to green technology, things like solar panels, nearly 70% of photovoltaic cells used in solar panels are produced in China. So if you're going to ramp up solar energy manufacturing, and you're going to ramp up your solar energy use, at the moment, there is no escaping heightened imports of the key equipment from China. Of course, India is trying to import substitute in that area as well. But when one country has 70% of the world's productive capacity, it's really quite difficult for others to emerge. So I think this is really part of my old thesis that China's overinvestment has caused an investment drought in the rest of the world. And it's time for the rest of the world to wake up to this and not ignore the fact that China operates a non-market economy, and we shouldn't be importing stuff from China as if it's a market economy. And this important transition really needs to be made. So far, I don't see it happening. I mean, there's a lot of rhetoric, but no real recognition that China has used unfair means to become a monopolist in so many areas of global manufacturing: steel, aluminum, cement, photovoltaic cells, artificial intelligence, a whole bunch of areas, 5G, telecom technology. So a number of areas, China has become almost a global monopolist in terms of its technology monopoly. So it's important for the rest of the world to recognize this, make some adjustments. And I think the good news is that India's earning praise from even the IMF for the rapidity of its green transition and for becoming something of a global leader. But almost nobody in the world, no country, is doing enough, fast enough to deal with the energy transition. The fact that India is being praised is actually an indictment for the rest of the world, because India is doing the best, but even we are not doing that well. I mean, most of our incremental energy is renewable energy. Most of the incremental power plants coming on stream in India over the last 3 or 4 years are renewable energy plants. So that is a positive. But you look at India's coal imports. Coal imports are up very sharply this year. And they're up nearly 67%, I think, the latest number. And coal imports are, I looked at the numbers, they're about 8.5% of our total imports. So we are making the transition, but not fast enough.
Right. Thank you, Mr. Basu, for your time. Pleasure speaking with you as always. I appreciate it, sir.
Great talking to you, Geeta. Look forward to seeing you next month.
Yeah, sure. Thank you so much.
Thank you.
Bye-bye.